as Nellie highlighted, fighting the financial crisis took extraordinary policy efforts across a number of fronts. I think the provision of liquidity to the markets and to market participants by central banks, the Federal Reserve and other central banks was obviously a very critical step in that process in terms of reacting to runs, preventing runs from turning into solvency issues, and if nothing else, creating more time for more comprehensive solutions. Now, the lender of last resort function is a traditional function of central banks, but of course the efforts that they undertook during the crisis were beyond the traditional in terms of the reach of those facilities, and it required a lot of innovation and creativity, both to figure out what the liquidity needs were and what the right response was. So it's a pleasure to introduce this panel, this set of lieutenants. They're all senior Fed officials at the time who were really at the center of putting together these facilities in the center of that effort to respond. So on the panel, we have Pat Parkinson, who is Deputy Director of the Research and Statistics Division at the Federal Reserve Board and involved with a number of financial market issues. Later moved on to become the Director of Banking Supervision at the board. We have Nathan Sheets, who is the Director of the International Finance Division at the board, hence frontline with many of the international efforts. And we have Trish Mosser, who was a senior official in the markets group at the New York Fed, and actually at the height of the crisis served as the interim SOMA manager with responsibilities for implementing a lot of these facilities. And we'll start off with Trish giving some introductory remarks.
Thank you, Brian. Good morning, everybody. So central bank liquidity provision, lender of last resort, is nearly always the first line of defense in a financial crisis, and 11 years ago was no exception to that. The timeline we've already done this morning, everybody knows it. Starting in August of 2007, the U.S. and global financial system started on a massive and very perilous deleveraging process that played out as a series of runs in wholesale funding markets, then a full-blown global financial panic, and finally causing the largest recession since the Great Depression. As the crisis progressed, the Fed created a series of innovative lender of last resort facilities for banks, for non-banks, and to provide dollar liquidity to the rest of the world. The development of those programs mirror very much the arc of the crisis that Nellie and Andrew were speaking about just a few minutes ago. The Fed started with very traditional tools, the discount window and repo operations to provide liquidity. They didn't work. Repo operations were necessarily limited by the need to control the Fed funds rate and the size of the Fed's balance sheet. The discount window is heavily stigmatized, and it is not used by banks even when market funding is scarce and very expensive. Instead, banks reduce their lending and their funding of customers, non-banks, and notably lending dollars abroad. It was not until December of 2007 when the Fed, in coordination with several foreign central banks, introduced two new facilities, the Term Auction Facility, or the TAF, and the central bank swap lines. Later, they would be massively expanded, and they were, in fact, the two largest lending programs that the Fed introduced. The TAF was designed very specifically to overcome discount window stigma by auctioning discount window loans. By having all the banks bid together, there was safety and anonymity in numbers, and a signal that this was a system-wide problem, not a problem with a specific institution. Importantly, the TAF facility was tied, both in policy announcement and even in operations, to the swap lines through which foreign central banks distributed dollars in their jurisdiction. The coordinated action by multiple central banks in December of 2007 sent a really clear message that the financial crisis was a global phenomenon. It would be jointly addressed. That practice had a pretty powerful impact, and it was a practice that was continued throughout the crisis. And it worked, at least for a while. The funding strains in US and Europe actually eased somewhat, but they weren't enough. As Andrew pointed out earlier, 2/3 of the financial system didn't have access to central bank liquidity. A systemic crisis calls for a central bank lending to the broad financial system, basically temporarily substituting for the breakdown in private lending relationships until the system can stabilize itself. But that absolutely can't happen if the lending facility actually excludes most of the financial system. So distress at non-banks continued and accelerated, particularly in repo markets. And as we all know, by March, there was a run in repo, the failure of Bear Stearns. And for the first time since the Great Depression, the Fed invoked its emergency authorities under Section 13.3 of the Federal Reserve Act to lend to non-banks. And the non-banks they lent to were the largest security dealers, who were the counterparties of the open market desk. The first two 13.3 facilities, TSLF and PDCF, I don't know why this is backwards. Sorry. I should have looked up. My apologies. The first two 13.3 facilities, the Term Securities Lending Facility and the Primary Dealer Credit Facility, both lent to the primary dealers against riskier collateral, but they were structured very, very differently. The TSLF was a term facility, security for security. It was also an auction. The PDCF was a discount window, effectively. As a result, the PDCF almost immediately became quite stigmatized, and the TSLF did not. Partly because of its auction format, and also because it was similar to existing securities lending operations. So it also had an additional advantage that it didn't increase the size of the Fed's balance sheet. The programs, but in TSLF in particular, were successful in temporarily stabilizing the repo markets into the summer at least. But again, the complete meltdown in global capital and funding markets after the failure of Lehman Brothers made clear that the existing lending facilities were just not going to be enough to stop the runs. And this, by the way, was despite absolutely massive expansion of the Fed's lending programs, unlimited swap lines, effectively unlimited TAF, and the abandonment of any sense of controlling the size of the Fed's balance sheet. I have not bothered to put a line up there for the failure of Lehman Brothers because it's really obvious when it happened. In response, particularly in response to the run on money funds and the collapse of the commercial paper market, they added two additional, particularly novel facilities. The ABCP Money Fund Lending Facility and the Commercial Paper Funding Facility. They were specifically designed to backstop commercial paper markets. The AMLF lent to finance purchases of asset-backed CP bought from money funds. And in contrast, the CPFF sort of lent indirectly via a special purpose vehicle directly to issuers. Both were very novel in structure. Both were effectively non-recourse lending, and they were riskier than previous facilities. That said, they both helped to stabilize the CP market, and they certainly provided a large quantity of funding to the wholesale markets. 2 words about the TALF. Only 2 words. There was really not a liquidity facility. It was a term asset-backed security funding facility. It was long-term lending, basically to restart the asset-backed securities market. Let me go back. The reason I want to mention TALF, though, is that it was the first, and I think only, market-wide lending facility that had an explicit Treasury credit backstop. The Fed's liquidity provision peaked at the end of 2008 as the panics and runs began to subside, and they rolled off quite quickly in 2009. The general consensus, not universal, but general consensus, is that they helped reduce the funding strains and slow down runs, but they certainly weren't enough to stop them. And one of the most important lessons to take away from all of this is that in an all-out financial panic, lender of last resort is not going to be enough. It is always going to be trumped by credible government guarantees, and in that sort of a situation, they're almost certainly going to be needed. A few lessons from the experience of 10 years ago. First, be prepared. Many of these facilities had the luxury of being created over weeks. Most were created in days and a couple in hours. And they were, as a result, not surprisingly, substantially revised and adjusted over time. Much more advanced preparation in normal times, in calm times, and testing of facilities is called for. The Fed, by the way, already does testing of monetary policy operations. It should do it for lender of last resort facilities as well. This will also, by the way, allow for earlier implementation, particularly for traditional authority facilities, assuming that they're warranted by the circumstances. Now, there's an important caveat here. Every financial crisis is different, and the facilities, particularly the novel facilities that are going to be most effective in the next crisis, are not going to necessarily be the ones that were used this last time. But the financial crises do rhyme, though. And planning, thinking about the future of lender of last resort is focus on the markets that are most runnable, where you're most likely to end up having to backstop a market, and think about how a lender of last resort might be designed there. Lesson number 2, plan internationally. In addition to the swap lines, the foreign banks borrowed more than 2/3 of the dollars lent through domestic conventional lender of last resort here in the U.S. The dollar is even more dominant as a global currency than it was 10 years ago, and its role is particularly larger in emerging markets. In the next crisis, the Fed will almost certainly face decisions about how to provide dollar liquidity to the rest of the world. The permanent swap lines are certainly an important step in that direction, but I think they're only one component of a plan. 3, plan to lend to non-banks. Traditional lender of last resort authority, is never going to be enough to handle a systemic crisis in a market-based financial system like the United States. So consider now in times of calm how one would want to expand counterparties, one would want to expand collateral. How much risk is the Fed willing to take and in what form? When and how to do non-recourse lending. How to coordinate, really important, with the fiscal authorities. And as needed, how to adjust the regulatory structure. There are, of course, 2 ongoing challenges always with lender of last resort. One is to manage moral hazard, and the other one is to manage stigma. With moral hazard, regulatory structure is always the first line of defense there. Managing moral hazard is an ex-ante problem more than an ex-post problem. But moral hazard is also impacted by the structure of programs, by their pricing, and by collateral. And so more thinking about consistency, and there wasn't complete consistency, to be clear, across those dimensions is important to do in advance. Stigma, of course, is a major problem for the United States in terms of lender of last resort. The lesson of the crisis is use auctions and tenders when you can. Use familiar operations, have everyone come in at the same time. It seems to work. That said, stigma is very likely to be an even bigger issue in the next crisis because of the Dodd-Frank requirements that borrowers be identified. And I'm quite sure I'm over time, so I'm going to stop and turn it over to Brian. Thank you.
So I think it'd be useful to start by digging in a bit into the breadth of the funding needs and what we might expect in the future. And I'll start with Nathan and ask, why were the dollar funding needs so extensive abroad? Is that something we should assume in a future crisis? And more importantly, does the Fed have a responsibility to meet those dollar funding needs if they reside outside the United States?
So thanks for that question. It's a pleasure to be here. I think it's useful for us to be thinking about these issues again, even though, as Andrew said, it's a bit painful. I think that the key element in thinking about this foreign demand for dollar liquidity is the key role that the dollar plays as an international currency. And as the crisis erupted, there were foreign institutions that had extensive dollar-based operations, both in the United States and in their own jurisdictions. There was extensive holding of dollar-denominated assets, and these folks needed dollar funding in order to have a match book. Now, at the same time, given that they were foreign institutions, they didn't have a large network of dollar-denominated retail deposits and were very dependent on the wholesale funding markets, like the FX swap market. And these were the markets that, at the height of the crisis, really got crunched. And as a result of that, foreign institutions turned to other sources. And this is when the Fed's liquidity facilities, particularly the swap line, stepped in to allow a smooth mechanism to respond to this dollar liquidity shock. In terms of the question as to whether the Fed has a responsibility to do this, I think that is a very tough question. But what I would say, and what we argued in the paper, is that the Fed has a strong interest in doing so. And I think this is the word that Tim Geithner used in one of the FOMC discussions, that disruptions abroad spill back into the United States. That was true 10 years ago, and I think it's even more true today. So it's very much in our interest to respond to that shock, given that the Federal Reserve is the institution that can create dollar liquidity.
And of course, the other dimension through which the breadth of these facilities took place was support for the non-bank sector. It's been noted a couple of times already that non-banks account for something like 2/3 of the credit creation in the U.S. financial system. So in some ways, it's not a surprise to have funding needs that reside outside the banking sector. I guess I would ask Pat, I mean, were you surprised by the extent of those needs? And when we look forward, given a financial system that's always changing, how well can policymakers actually anticipate where in the non-bank sector these pressures might emerge and be prepared for that?
Well, I think essentially it was not only that so much of the credit that the U.S. economy depends on is being provided by the non-bank sector, but that a substantial portion of the funding of those credit extensions was through short-term wholesale funding, particularly secured financing, where they were borrowing through instruments that provided collateral to the investors, whether that was ABCP, repos, or other instruments that the investors had regarded as relatively risk-free, such as shares in prime mutual funds. But when the investors lost confidence in the risk qualities of those instruments, they ran on them. And in each case, I think the size and speed and severity of the runs was a surprise to me, and I think to others at Fed. I think we believe that compared to, say, the kind of unsecured fundings that many banks raise in the CD markets and whatnot, that investors would stick with them because they feel even if the institution was troubled, they still had the collateral. As long as they had confidence in the value of the collateral and their ability to liquidate it promptly, they'd stick with them. But that didn't prove to be the case. So there were ones on repo, ABCP, et cetera. I say that was certainly a surprise to me. I think it must have been a surprise to others, or we would have taken more ex-ante regulatory measures to require better liquidity risk management by people that relied on those types of funding vehicles. And we've been better prepared and wouldn't have to scramble as much to come up with programs to address the runs once they occurred.
Let me turn a bit to the speed of the response. I think the big picture here is there was a lot of innovation. Things happened in a remarkably timely way given the innovation required. But I don't know, if we dig a little deeper and just ask, well, were things a little too slow in some areas? Like one example that's mentioned in your paper is that the TAF and the liquidity swap lines weren't implemented until December, whereas the funding needs really began to emerge in August. So there was a pretty meaningful gap there. So a broad question actually for anyone on the panel, was the speed fast enough? The speed of response, could it have been more timely? Would that have made a meaningful difference?
Since you brought up TAF and the swap line switch, sort of traditional authority tools, I'll start and then everybody else can leap in. I think my personal view is that it was slow. My view at the time was that it was slow. Now, there were good reasons for that. First of all, TAF existed on a piece of paper in August of 2007. The swap lines had been used exactly once after 9/11, 17 years ago. They were not the sorts of tools that you did easily or lightly, and it was pretty clear that if you introduced them, that they were going to have to be around for a while. So a certain amount of operational and justifiable, I think, policymaker caution about jumping in to provide liquidity unless you're absolutely sure with facilities that were pretty much untested, at least in the way they were going to be used. And that's completely sensible. It's one of the reasons that I think one of the lessons of this is testing traditional authority facilities in the way that monetary policy authorities are, operations are tested would be very helpful, because then the decision for the policymaker is, okay, we have a facility that we know will probably work. Is this the right time to implement it or not? But the delay over the fall was a combination of all this, and not just at the Fed. I think there was certainly reluctance at the other central banks as well to think about whether they needed how quickly they needed to start these facilities. But the reality was, over the course of the fall, the funding maturity shortened up. The walk maybe is a better way to describe it, in wholesale funding markets got worse, and it wasn't until December that things were done.
So I think it's clear ex post that we should have moved more quickly. Ex ante, trying to put myself back in those circumstances, there was real uncertainty about the extent of the shock. And there was also real uncertainty about the nature of these responses and the risks associated with these responses. As part of this project, I spent a fair amount of time reading some of the FOMC discussions in the transcripts. And even in early December, when the LIBOR OIS spread had spiked and there was substantial tension in markets, the FOMC was broadly supportive, but there was a dissent, and other members of the FOMC had certain reservations. So even at that retrospectively late date, it still was not obvious to every reasonable man and woman around that table that this was a necessary response. I think, having learned what we've learned, we'll respond better in the future. For example, in May of 2011, when the euro area crisis erupted, immediately the ECB turned to the Federal Reserve and proposed swap lines, and the Federal Reserve brought the swap lines back in full force. So you compare the speed of the response in that instance to the earlier instance in 2007, it was much stronger. So I do think there's been learning, and now the swap lines are standing and available. So part of it is we hadn't seen anything like this for many years, maybe since the Great Depression. And there was a lot of real-time uncertainty about the nature of what we were dealing with in the responses.
So I don't disagree with Nathan that there was a lot of uncertainty, but introducing 13.3 facilities, that's a high bar. It's always going to have to be a very significant disruption before, just for the legal standard, before those sorts of facilities are introduced. So I think another argument, if you like, for erring on the side, if you think you have a systemic liquidity problem, of erring on the side of having the traditional authority facilities ready to go is that, because you know it's going to be a gap before you can expand beyond it.
I mean, so does that mean the 13.3 facilities are just always going to be responsive? And I mean, is there anything to note about the speed with which they were stood up?
I think one thing that we learned is, depending on the nature of the problem you're trying to solve, you may have to create a lot of new market infrastructure to be able to carry out the programs. That operationally they can be quite complex. Both simply setting up the account relationships to actually lend money and take collateral from individual parties, and then all the risk management that has to go around it in terms of valuing the collateral, making sure you have it, et cetera, et cetera. I think the interesting contrast is between the AMLF, where we didn't have to set up new infrastructure. We used the discount window, and we got that up and running within a week. And the other facilities I was most closely involved with, the CPFF and the TOF, took weeks in the case of the CPFF and many months in the case of the TALF. And it wasn't, again, I think more or less the same people were working on those things. So it wasn't that they were working harder, but rather that just the amount of work that had to be done to safely launch some of those programs was quite large. And I think this is a point that Trish made. Even if you're not yet convinced that you need to launch a particular program, I think it would behoove the Fed to ask themselves, all right, suppose in another month we decide to pull the trigger. How long, what can we do now to be able to shorten the period between the decision to launch and the time at which the credit actually reaches the financial system?
I think another important conditioning factor in thinking about this issue and the speed, and also as it applies to the 13.3 facilities, is the political environment. Through 2007 and 2008, as the Federal Reserve was putting in place these facilities, which were necessary to respond to the crisis, I hate to think what it would have looked like without this response. When Ben would go to the Hill, he was rarely greeted with hallelujahs, and even ex post in Dodd-Frank, Congress trimmed the 13.3 authority, so it is less flexible than it was before. So we've learned some lessons, but there are other folks out there who have looked at it and have learned different lessons. And, from my perspective, that means we've got a little less ammo than we had before. But that's the political realities are another factor that we need to think about. And we're at least something of a constraint through this period.
We actually have a question from the audience that I think is relevant for the timing question. The question is, wasn't the monetary policy framework a significant constraint on the implementation of these facilities?
Yes. It's the short answer. The Fed did not have the ability to pay interest on reserves at that time, and the federal funds rate was positive, significantly positive, I believe 5 and something. Someone can remind me what it was in August of 2007. And it didn't get to 0 to 25 until December of 2008. So until the Lehman Brothers failure, every dollar that was lent out had to be matched by shrinkage in the Fed's balance sheet. My slides aren't still up there, but I could toss up the picture of the lending. And you can see the sell-off and roll-off of U.S. Treasury securities that came out of the Fed's portfolio. So they, if you like, the Fed sold or allowed to roll off Treasury securities from the balance sheet as the lending programs grew. That actually constrained the size of the growth and how quickly certain facilities were stood up. They were rolled out slowly and then grown over time. That was partly, of course, because the crisis deepened, but part of it was how quickly can we roll this off so the Fed funds rate doesn't collapse. It happened with PDCF. It happened with TAF. And after Lehman Brothers, of course, there was no attempt at that point to try to control the balance sheet. And the federal funds rate traded well below its target for most of the rest of the year until the target fell, basically to where it was trading. I'm exaggerating slightly, but not a lot. It was also one of the reasons, of course, that the TARP legislation included the speeding up of the authority of the Fed to pay interest on reserves so that it could, in fact, have both a large balance sheet and control interest rates at the same time, which in the last couple of years it's shown it can.
Maybe I should have read the rest of the question, which says, doesn't this imply that a floor system is preferable? Just in the interest of time, I'll answer that and say, I think so, yes. I think, a floor system allows these decisions about liquidity support and also decisions about asset purchases to be made independent of the decisions about the short rate, which seems advantageous. Let me turn to risk. These facilities, differed a lot in terms of the type of risk they assumed or how they mitigated that risk. Right? We have the TAF that used traditional collateral that was already posted at the discount window and used counterparties for which the Fed had a lot of regulatory oversight. And then we had other facilities that were new markets, CPFF, TALF, others, where the Fed was dealing with other types of counterparties and the collateral questions were more challenging. So I guess the question is, in your view, did the risk vary meaningfully across the different facilities, and did the Fed end up kind of at the right point? I mean, in some ways, if you're lending and you have very little risk, then you're serving a pure liquidity function, and it mitigates a lot of the concerns. But in practice, you never have that situation. So just trying to get a sense of where you think the Fed ended up in practice.
I think actually, in respect to the 13.3 facilities, I think the risks did vary a lot across the facilities. We have differences of view on that among people who are actually involved in it, but louder, closer? Okay, louder. But actually, the ones I guess I was most involved with, especially the AMLF and the CPFF, I think those were pretty risky. I don't regret having launched the facilities because I think the alternative was a much more severe contraction of credit. In the end, we didn't lose money on these, although I worry that if one concluded they weren't risky because we didn't lose any money, I think that's another case of what was called, after the crisis, a failure of imagination. It's not hard for me to imagine how things could have gone badly, and I probably would have held accountable to some extent. But some of that was simply, again, a structural problem. As the ABCP market, 50% of the ABCP was sponsored by 5 banks. So I think we had a lot of concentration in those programs by virtue of that. I think it would have been a mistake to rely on the fact that they were A1, P1 rated. I don't think neither the rating agencies nor the people that were investing in that paper had a particularly good idea of exactly what the collateral was backing. That's why when it started out as concerns about subprime collateral or mortgage collateral in general, they ended up running on all the ABC programs, even though many of them structurally were not allowed to invest in mortgage assets. So, but again, I think a key thing is you have to ask yourself, anytime you see large amounts of short-term wholesale funding in the financial system, ask yourself, is that stuff runnable? And if it did run, how would the Fed respond? Could the Fed address the run in a way that didn't pose significant risk to the Fed? And if the answer is yes, it is runnable, and I can't think of a way the Fed can do it without taking some risk, it's time to take ex-ante regulatory measures to shrink the size of those vehicles that could give rise to the problem. And that's the right way to do it, because once you get into the crisis, the problem is if the Fed is unwilling to lend, then the balance sheets to the financial institutions are going to shrink, and that's what takes the crisis from being sort of a Wall Street crisis into being a Main Street crisis, and that's what we were trying to head off. And at the end of the day, I think the programs were successful in that regard.
I mean, on this topic of risk, I wanted to circle back to the swap lines. The swap lines were extended to 14 countries, including a number of emerging market economies. I think what is one aspect of that that's interesting is there are standing institutions that serve to combat crises in emerging markets, such as the IMF. So one question is, was it right? Does this responsibility fall to the central bank, or should it fall to those other institutions? And there's a broader question that actually came from the audience about how receptive the other central banks were to the swap arrangements.
So in response to the first part of your question, I think that the size of the flows, the financial flows and other flows between the advanced economies means that backstopping those, providing liquidity in those spaces has been and is likely to always be the unique jurisdiction of the central banks. The main alternative international institution, being the IMF, simply doesn't have the resources to be able to provide a credible backstop. And it does broad surveillance of advanced economies, but historically, for decades at least, has not lent to them. For The emerging markets, in contrast, my feeling is and has always been that the IMF should be the first port of call for these emerging markets during times of crisis. Now, that said, I would also quickly add that there were some truly extraordinary circumstances that existed during the peak of the financial crisis that prompted the FOMC to make the decision on these swap lines. First of all, the crisis itself was exceptional, as has been articulated by a number of speakers already. Second, the resources of the IMF were significantly smaller than they are now. And with the global stresses, there is a reasonable expectation that those resources would be stretched. And then finally, the IMF had not yet developed a rapidly dispersing liquidity facility that would be appropriate for the very, very top tier of emerging market economies. So under these circumstances, the Federal Reserve felt it exceptional and approved these swap lines with four important emerging market economies. And I thought at the time, and I very much think in retrospect, that it was exactly the right thing to do. Now, given the evolution of IMF funding and the IMF suite of facilities, will those circumstances ever repeat themselves in the future? I think that the bar for it to happen, my personal view is it's exceptionally high. But if we ever see another global conflagration, hopefully it won't happen in our lifetimes, that will be a decision for some future set of policymakers.
This question says, can Tim Geithner say something? I'll answer that, yes.
I asked David if I had to write the question down. He said no. I'm biased and can't claim any wisdom in hindsight. And my tendency is to think that the 13-2 facilities, I think, were very cool and very consequential and very important. And I think it would be better for us to run a system where this stuff was in place as a standing piece of the broader safety net for the financial system, and that would help avoid the mismatch between the scope of these protections and the structure of the financial system in the future. You guys all wave at that in your papers, but I think you should be for that. And it's not, the authority is not well designed, partly because, as Trish said, things have to be pretty terrible before you can act. Things have to be pretty far past the point of no return before you can act. And the stigma in the new law and the constraints are designed to make it less effective than it should be, and I think that's something we should lament and fix. But let's ask the harder question. If you look back, there's no unpolluted experiment in this case, but if you look back at the outcomes from these programs, they were programs, when enacted, were like a light switch. Spreads came down, issuance restarted. CDS compressed. And there were programs where stuff kept eroding. And in a simple way, the way to say that, all the fancy lending against collateral stuff the Fed did to the non-bank system, not all of it, but because that's sort of a very weak backstop, stuff kept eroding. So although I'd be for the general perspective, this is valuable stuff, important to have there in place, and earlier recourse to it is probably valuable, particularly in a situation where you have the fire sale that's going to pollute prices and raise concerns about solvency. I think there's a very good argument for doing that. I think you can look back also at this point and just say it's another example of the lesson that many of you have already said, which is that in the severe crisis, it's only the guarantee or the capital injection and the broader fiscal stuff that stops a run, reduces the incentive to run. So, I don't know. We tend to attribute a lot of coolness and consequence to this stuff. But I wonder whether you look back on this and say, well, the lesson you should take is, yeah, sure, more sooner. But it's evidence of the weakness of that part of the central bank put. And that it's another example of why, if you want to protect yourself against these things, you need to have a better standing financial resources and authority to put in place tougher guarantees. You can't answer the question, what if you'd lent more freely, aggressively against broader collateral with thinner haircuts much more early? You can't answer that question really. You don't really know. But you know that when you did it, it didn't have much effect.
So I'll just repeat what I said earlier. I agree with you that ultimately in an all-out financial panic, guarantees are always going to, it's the reason within traditional commercial banking that deposit insurance trumps lender of last resort, but it's very useful to have both. And I think that's the case as well here. I will say that you don't know what the counterfactual is. You don't know whether you might have bought more time, or maybe that you would have might have still needed the guarantees, but would there have had to have done as much? That's the question. This particular crisis was so severe, the idea that you weren't going to need government backstop seemed seemed probably naive to me, but we didn't know that going in. It was very hard to tell in the moment. It was pretty clear that it was very systemic and global from the get-go. And having a response that policymakers would say, yes, let's do this and let's do it big and in force, could it have made the pain a bit less and the need for guarantees a little smaller? Perhaps. So the system could heal itself a little bit more. You don't know that it would have helped, but I doubt it would have been hurtful. And I think if it were well planned and well executed, the moral hazard implications of it would have been pretty small. That's my personal view.
I mean, I guess one related question, right? So in an ideal world, you have standing facilities or agreements by which you can respond to a financial crisis on a number of fronts with sort of well-defined rules and immediate availability. Obviously, that's never going to happen, and if anything, we've probably gone a step or several steps in the other direction. So I guess the related question I wanted to ask is, do increasing constraints on the ability to give guarantees or other support affect the way central banks should operate? Should it affect their willingness to provide liquidity? And I'm not sure in which direction that goes, so I'm going to just throw that to you guys as a question.
Sure.
In which direction?
So, I think if you have less powerful tools to fight a severe crisis, that means you need to be all the more aggressive up front, doing the kinds of things that Trish has articulated. Even also recognizing the reality of what Tim was saying, that as the crisis proliferates, it's not going to be the lender of last resort that solves the problem. It's more likely to be the fiscal and the guarantees. But then that also opens up a central tension in all of this, in that you're only going to get that fiscal and the guarantee from the political establishment once there's enough pain in the economy. So unless Congress writes a big check and provides a lot of fiscal authority to the technocratic establishment, which I don't see happening anytime soon, we're kind of stuck in a way where, in order for it to be bad enough for Congress to act, it's going to be at a point where all of us are shaking our heads and saying, why did it get this bad? And I don't know how to resolve that. And I think the quote-unquote reforms to the 13.3 facility have accentuated this catch-22, is you can't do 13.3 facility for a single firm. You've got to show it's a class of firms. And the only way to get a class of firms in a way that's likely to be persuasive is to let the thing proliferate and cascade for a while. So this is a tension. The only thing I can think of, going back to your initial question, is just got to be all the more aggressive on the front end and hope that somehow the Badgett-style lending is sufficient, but it may not be in response to some shocks.
One question that came in, which I think is straightforward, is whether all these facilities would be possible going forward under Dodd-Frank. I assume we think yes.
Well, these, I think, are all what were called broad-based facilities. I mean, clearly the legislation prescribed the narrow facilities. There are other provisions of it having to do with collateralization and other things that I think are intended to make it more stringent. But I don't think interpreting that is straightforward. I think at previous conferences I've been at, various former Federal Reserve officials and both generals and lieutenants have expressed different views as to whether certain programs that we actually used during the crisis would be permissible under the new authority. So unfortunately, it's not straightforward.
So we can talk about future crises and not knowing their exact nature and what the liquidity needs will be. But there's one area that you raise in your paper and other Fed officials have raised, which is should there be a standing facility for broker-dealers, something like the PDCF? Is that a recommendation you would make?
I think with one significant caveat or proviso, it is a recommendation we made in the paper, and that was that broker-dealers that are subject to bank-like regulation with respect to liquidity, capital, et cetera, that they should have access to some sort of standing facility. The traditional reluctance, I think, for providing a standing facility to someone that's a non-bank is that it's the moral hazard, it's competitive equity issues, but the fact of the matter is, if you look at the composition of even the primary dealer community today, I think all but two are bank-affiliated dealers, and all but a couple of those bank-affiliated dealers, the legal entity that's the primary dealer is a broker-dealer entity, and through a number of changes in the facts on the ground since the crisis, all of those are at least subject. They're either parts of bank holding companies, or in the cases of the FBOs, they're now forced to form an intermediate holding company of which the broker-dealer is a sub. And the Fed, I don't think it's done it completely, but it certainly could impose the very same capital and liquidity restraints on those holding companies as on others. And if one then worries, as some do, a step further, well, what about the broker-dealer entity, the sub itself? I think through the resolution planning process and these requirements for pre-positioning capital and liquidity, you pretty much get the same places to get to with an insured depository institution. So if that's the case, then it seems, yes, moral hazard is an issue, but you can deal with it in precisely the same way that you deal with it for depository institutions, and that's through ex-ante prudential regulation.
Okay, so this maybe a broad summary type question. So here we are. We've been through the drill once. Presumably that's helpful in a number of ways. I think understanding the runnable nature of firms outside of banks. I think we're all Fed staff, and the rest of us are probably better at thinking about financial stability risks and what measures, what warning signals to look for. You've all implemented this wide array of facilities and hammered out, a number of specific issues on that implementation. We just have experience doing this. So that all seems like we're better off. On the other hand, as has been discussed, we know this was only a part of a response, and it's hard to get, it's hard to anticipate the complete response in the future. There was a lot of backlash, not just to this, but to other Federal Reserve actions. And we have additional restrictions now, legislative restrictions on the ability of the Fed to serve the lender of last resort role and other government efforts. So on net, where does this leave us? Do we, I doubt it leaves us confident, but does it? Are we better prepared for the next financial crisis?
Well, for,
Yes or no?
yes, but not so much because of lender of last resort. Can I put a but? Which I think for most of the facilities here, one way or another, that we're discussing about, not only individual institutions, but broadly, there would certainly be constraints, but I don't think it would make most of them impossible. The reason the financial system's safer, though, is because there's just lots more capital and less maturity transformation, particularly at the core of the system. But we know how this story goes. You don't have a financial crisis every 5 to 10 years. If you're fortunate, like the United States, you have one about once every 75 years. And the degree of innovation and change in the financial system between now and then, particularly if there's small regulatory changes, which is kind of what happened before this crisis for 75 years, then you end up in a not very safe place because this system sort of innovates around. That, I think, is the danger, both from the regulatory structure standpoint as well as from the lender, potentially from the lender of last resort side. You need, I think, lender of last resort is used so seldom in the United States that we did not, as Ben mentioned at the very beginning, think about this enough beforehand in detailed ways about what we would do, even though we knew the financial system was changing in structure. So that, I think, is one of the biggest lessons, and where I'm worried that the system, by the time we get to the next crisis, may not be much safer than it was in 06 and 07. So that's my fear, now versus the future.
So I think the system is stronger as a broad statement, but particularly with respect to liquidity, which our session here has focused on. We now have greatly enhanced liquidity regulation. In addition, I think over and above the regulatory requirements, I think major financial institutions realize that they need more liquidity on their balance sheet than they thought was the case a decade ago. In addition, I think policymakers have learned important lessons from the crisis. Many of them we've discussed over the last 40 minutes or so. Now that said, I agree with Trish that for both the increased strength of the financial system and its increased liquidity and the recollection of the lessons that were learned during the financial crisis, there is a rate of decay. And I think that's one reason why projects like this one are constructive. They're hopefully what we can do by writing these papers and by having a conference like this is remind ourselves and other policymakers and help slow that rate of decay, but there is a rate of decay. And then the final point that I would make, this again very relevant to this particular panel, is we do have, as I indicated earlier, standing swap lines, so they are there and ready to go. And all of these other facilities that we've discussed, they're on the shelf. And every crisis will certainly be different, but the extensive liquidity facilities in so many different dimensions, addressing so many different markets, it seems to me how that couldn't help but be useful for a crisis any time in the next few decades. If it's 75 years out, then it could be a completely different financial system yet again. But for the remainder of our lifetimes, it seems like that the blueprints that we established in weeks, days, or hours, depending on the facility, they're there and they're helpful and they're instructive.
I think in that regard, it's not just the blueprints, but it's fine to create a blueprint, and it's mainly senior policy people that create the blueprints, but then you have to execute. And one of the things I think that for a good long time is going to make us stronger is the fact that particularly people at New York Fed that stood up all these programs so quickly, as long as they're around, I suspect that our ability to get things stood up quickly will be better than it was.
Okay, so extension of retirement age for New York Fed staff. That's the recommendation. Okay, I think we'll leave it there. So thank you very much to the panelists.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.